Hello everyone, my name is Majid Rahimi and you're watching part 11 of our classical technical analysis course. If you want to watch this course from scratch, you can reach the first video here. Don't forget to click on subscribe button and the notification bell under this video if you are not a subscriber yet to get notified when I upload a new video. In previous videos, we have talked a lot about important reversal patterns. In this video, we will end up this series of patterns by looking at broadening formation, diamond, wedge, one-day reversal, and some very short-term patterns. Broadening formation only happens at the top of market in stock markets. These patterns shows that the amount of intelligent money is very low and market is somehow confused. The result of this pattern is falling in price in most of the cases, so it would be an important sign for shareholders to get out of the market as soon as possible. In this pattern, volume is still high and it has an irregular manner. And finally, we consider it as a pattern in daily charts, and if we see it in weekly and monthly chart, it doesn't tell us anything. Again, I have to say this pattern doesn't mean falling in Forex market. Falling in Forex is not happening because we're not buying something, we're just changing our currency. The next pattern is diamond. It can be a reversal or a consolidation. So price can rise or fall depending on which side it penetrates. The maximum width of the diamond gives us the minimum target of diamond, either in bullish or bearish market. The next pattern is wedge. Wedges are in two different types, falling wedge and rising wedge. They can also happen for both consolidation and reversal. We should expect a rise in price after a falling wedge and fall in price after a rising wedge. Wedges usually take more than 3 weeks to appear on chart, so if you see something like this in less than 3 weeks, you should consider it as another pattern which we are going to talk about later. One-day reversal is a day with unusual high volume and great changes in price. And also, they are not a definite signal for change in major trend. We have some other short-term reversals which can also be considered as one-day reversal, spikes, runaways, and key reversals. For understanding these short-term events, let's suppose that we are at the end of a bullish trend. A spike at the top of a bullish trend is defined with a high range changes in price which registers a significant high and closes near the close of yesterday. A runaway is a wide range day with a low near open and a high near close. Key reversals are 2 days the second they can register a high more than yesterday, but it closes in somewhere lower than yesterday's close. They all mean reversal, and we should be careful if we see any of them, and we should watch closely on our chart to see what happens next. These very short-term events can be used by scalpers and for short-term traders. We will talk about these kind of patterns when we start our candlesticks studies later. In this video, we end up reversal patterns which we had started with head and shoulders. In the next video, we're going to talk about consolidation formations. Share our videos with anyone you think that might need them. Thanks for watching, have a good time, and bye.